What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update is we're going to be taking a look at the ORTAX data, but from a different lens than we typically do. I have found something in the data that I really want you guys to all understand, and it gives us a lot of insight into the price level as to where these shorts are going to be having a lot more problems. This is a really key piece of information that I really want people to fully understand, and I think should be shared with the AMC community. Now, the second thing, we are going to be taking a brief look at the option chain, but the two main important things that we're going to be looking at in this update video is this situation with a hedge fund that has collapsed. They are closing their doors, but there are some very key things that are mentioned in the article surrounding this situation that shows us that this institution is having so many problems with over leveraging, their position sizing, and just essentially netting out all of the obligations that they need to pay in order to essentially close their doors. Now, the last thing is going to be this SEC situation, and a really good step in the right direction moving forward, where they're going to be requiring, in their own words, firms like Archegos to start reporting on a lot of these swap transactions and the swaps that they are holding. The reason why this is so important is because when we looked at that comptroller of the currency research report that we have looked at a couple of times over the last couple of weeks, swaps are always the highest dollar amount exposure that a lot of these institutions have. We know that we've seen Goldman Sachs' leverage level at 133 to 1, and that should not be able to happen right now. But if these firms are going to have to report, well, there's going to be a lot of big moves coming in the market in the near future. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So when we're looking at the price action of AMC today, again, it was another day filled with uncertainty until we got that Federal Reserve report at 2 and then Jerome Powell's remarks at 2:30. Those over-leveraged shorts really took the opportunity to try to knock us down even further, all the way down to $22.53. But with what we've seen on AMC time and time again is that you cannot hold it down for very long. You can do everything in your power in terms of the shorts to try to keep it low, but at the end of the day, the apes and the institutions that see AMC going higher in the future are going to step in, continue buying, and the apes are not leaving. Now, when we look at the ORTAX data over here, a lot of people were saying that this was an all-time high in terms of the estimated short interest. Now, it's not that big of a deal at all, but when I was thinking about this, I remembered seeing a 21% estimated short interest number, and I did get provided with that screenshot. So we aren't necessarily at that all-time high estimated short interest yet, but this is still incredibly high. The utilization at 78.29, honestly, a little bit low for the amount of estimated short interest that we're seeing, but I still would expect to see the utilization get above 80 going into the end of this week, and maybe even above 85. Now, what that does is eventually, as the utilization starts to climb up, the cost of borrows go up as well. Just think about the market for lendable shares, just like basic supply and demand. If there is scarcity, you are going to have to pay more for whatever that good is. In this case, a higher cost to borrow. Now, the important thing that we need to take a look at here is the average days on loan of a short. We can see that over the last couple of weeks, the average days on loan went from 76 days all the way down to 63 days. That is a very significant decrease. Now, what does that tell us? Well, over the last 2 weeks, a lot of shorts have on average been piling into short positions more than we have seen in the past. So what does this tell us? Well, remember a couple of videos ago when we were looking at the year-to-date chart of AMC and we were taking a look at this level right here, this consolidation level after that massive run-up before we started to break down. This is what I was calling the danger zone. This was the previous danger zone of AMC. But now that we've seen the shorts really start to add to their position down at these levels, and remember, this danger zone is low to mid 50s. Well, the fact that they have significantly decreased the average days on loan of a short is telling us that they're shorting aggressively around these levels. So the danger zone on AMC in terms of what price point we would need to get to for those more recent shorts to really get put under pressure is lower. Could it be 45? Could it be low 40s? Could it even be upper 30s? Price levels that we have seen on AMC many times. It easily could be. So once we get back up to those price levels, it might be easier for us to really get the next leg up going, easier than it was previously to having this big breakdown. Now, when we come over to the option chain over here, well, we're still seeing a decent amount of puts in the money for this week. Again, we didn't have that big of a green day today, 0.65% in the green. And in the after hours right now, I'm seeing 0.57% in the green in addition. So we are going to need to see a lot more bullish momentum to really get these puts out of the money and get that gamma squeeze in terms of the unhedging of the puts that the market makers are going to have to do once these put contracts that they've sold start to run out of the money. Now, let's get into this situation with this hedge fund that has seemingly collapsed. Now, when we come over to this article right here, Anchorage Capital, one of the biggest hedge fund investors in distressed debt, is closing its flagship fund after 18 years in returning the $7.4 billion it manages to its clients. But there's kind of a catch here. Anchorage didn't give a date by which clients would receive all of their money back from the fund, which holds sizable positions in companies including Hollywood Movie Studio, MGM Holdings, and J. Crew. So Anchorage, which has roughly $30 billion of assets, so it manages $7.4 billion, but it manages $30 billion of assets. That's a pretty high leverage ratio right there. Said it would focus on its structured credit and private equity style funds that call down capital from clients. They manage about $18 billion and $4 billion respectively, structured finance vehicles like collateralized loan obligations or CLOs. Now, taking a look at this right here, what it looks like is they don't give a date by which the clients will receive their money back. Well, if they were just closing their fund for unrelated reasons, they would be able to liquidate their positions. They would have a decent understanding of how long it would take them to do this because they know. When you think about moving big money in and out of the market, there's a certain time frame and certain amount of orders and money that you can put into a trade at any given time without moving markets. That's kind of one of the main purposes of dark pools. But if they don't know when they're going to be getting this money back to their clients, well, it tells me that they have to do a lot of netting to really figure out what their net obligation is on a lot of this distressed debt. Now, in addition to this, something funny that has popped up, Anchorage sounded very familiar to me. And when you come over to AMC's institutional ownership page, or actually just Anchorage's previous 13F filings, we can see that they used to hold about an amount of put contracts that was controlling 4 million shares. So it's not that crazy in terms of the puts, but when we look at the first quarter that they owned these puts, Q2, so it's very possible that they bought these put contracts well before the big June run-up. And even at the price levels that we're seeing at right now, the put contracts that this institution Anchorage would be holding would be essentially worthless at this point because the stock has essentially almost tripled since those levels that we saw before that massive June run-up. Now, let's get into the situation with the SEC in what I would like to think of as a really good step in the right direction in terms of getting more market transparency. So the SEC plan forces firms like Archegos to reveal swap positions. So U.S. regulators are seeking to restrict hedge funds and family offices from using complex derivatives to secretly build huge stakes in public companies, the types of trades that fueled the collapse of Archegos Capital Management. If you guys have been listening to any of my live streams or any of my videos when we talk about Archegos, what I like to say a lot is that Archegos is not the only one that was doing this with these total return swaps. They were the only ones that got caught. They over-leveraged themselves and the positions began to go against them to the point that Credit Suisse needed to forcibly liquidate their positions. Now, there are definitely more of these large hedge funds, even small and medium hedge funds out there doing this right now in order to gain that leverage. So the rules outlined on Wednesday would require more disclosures and place additional restrictions on firms that trade security-based derivatives. Positions worth at least $300 million, or the equivalent of 5% of the shares trading in an underlying stock, would automatically trigger the new SEC requirements, and notional values as low as $150 million could also force reporting. Investors would also have to disclose their identities, positions in the swaps, and underlying securities, as well as related loans, according to the SEC. So what this is essentially saying here is the SEC is going to know who is doing this, in what stocks, and what are the leverage levels of these positions. This is a really strong step in the right direction, but we also have to see really how enforceable is this. Now, just to give you guys a little bit of a perspective of just how big this situation is with derivatives, we're going to go back to the Office of the Comptroller of the Currency's derivatives report. We can see that in total right here, $183 trillion in total derivatives exposure, and in total swap exposure, out of that 183 trillion in the US, 106 of that trillion, or 106 trillion is swaps. So this market is absolutely huge. It is a dark market. It is very manipulated. And the fact that we have firms like Archegos, that when one firm ends up having significant issues, stocks like Viacom and Discovery can fall 75-80% in a day. This poses substantial risk to individual securities in the overall market. So this is going to take a really good step in the right direction in terms of swap reporting and more transparency of potential short positions out there. So we're going to have to wait and see how this goes, but this is really, really good news. So that is mainly going to wrap up this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next video.